Good morning, this is Andrew from Trend Following Mentor. Today is January 16th, 2014, and we're going to talk about the stock market, the situation in the S&P 500, which I use as my barometer, and also the idea of using stops and how stops can protect you when you're trend following. First, as we always do, is we look at the S&P 500, and you can see that we've had some recovery from the other day, going to new highs on some of the indices. The only problem I still have with it is you still have a little bit of divergence here, which is a negative. This run up for the last 2 days, we're on very, very light volume when you compare it to the negative volume here. So you had 149 million versus 100 million and 98 million. So I mean, you really want to see volume going up big movements going up. Like this was big volume going up 234 million. So always you want to watch price action and volume action. Look for like subtle scenes of what's happening. With, let's say, MACD with a divergence. But on the positive side, one of the distribution days fell off because they're good for approximately 25 trading days, and one fell off from last month. We did have one here. So we're working to repair that. The other thing also, just to keep in mind, as I'm saying there's absolute optimism. We're at an extreme high of 61.8 of investment advisors that are bullish, which is a negative for the market, as well as the extreme margin debt. And what I want to show you is that even in a bull market, things can really fall out of bed, and they can fall out of bed quickly, and that's why you need to be trading with stops. We can start with this one, this NQ Mobile, and especially when you're trading let's say the higher momentum stocks. This stock was a big winner here, and it was a breakout. You could have ridden this thing up from, let's say, 10. Probably no one even heard about it by then. And it ran up, and then one day, some negative news came out, and this thing just completely fell out of bed from $23 down to $8. So what do you do to protect yourself? Again, I can only make suggestions. None of this is made for your own personal direction or benefit or stock tips. The idea is to educate you, to try to put a plan together, because if you have a trading plan, you have the greater propensity to succeed. What I do in situations like this is, first of all, I scale off profits. When I'm up, let's say 20-25%, I take some chips off the table and bank them. And again, it all depends on your rules. Some people might take all of it, some people might take half, some might take 25%. It's something for you to consider as part of your rules. But you take some chips off the table when you're up 20-25%. Then I use this 50-period exponential moving average as my line of demarcation. If I go below this line more than 5%, I'm out. So you can look the prior day. The prior day's exponential moving average was 1875. And do 5% below that, you probably would have gotten taken out here. I don't have a calculator offhand, but I would tend to believe you might have gotten taken out. But on the same token, let's say here your exponential moving average is 2002 and you do 5% below that, so you're at, let's say, $19, you would have avoided all of this nightmare. And this is just with one stock. And these things happen, and I'll show you they happen all the time. And even with good stocks, supposedly they can happen. But these are the momentum stocks. This is what happened yesterday, and that's why I'm bringing this up. Nu Skin. Putting things into perspective, Nu Skin, if I'm not mistaken, let's say from 2013, if you want to start the beginning of the year here, it went from 40 to a high of about 140. So you're talking, this thing was up more than 300%. And then one day, it just completely fell out of bed. What you can do, very simple rule again, is you look at your last day's close, look at your moving averages of 127 and change. You can see it on the left-hand side of the screen. It's 127.21. Do 5% below that. You go 5% below that line, you get out. You exit. Nothing to think about. Protect your profits. Another example. This one happened yesterday, and this is a stock that I like. It broke out and went up almost 20%. The breakout point was at about 50.75. It went up to about 59 and change, so almost 20%, and then completely fell out of bed. Big loss in the news. And the way to prevent it is a couple of ways. One is you don't want to give back 20% of your profits. You don't. It's really not smart. The other, let's say if you wanted to let it ride, you still could have gone 5% below this exponential moving average, this 50-period exponential moving average, and you might have lost a little bit, but you would have lived another day. This is a big loss otherwise, very big loss. So really, what is my point here from Trend Following Mentor is to try to teach you to have a trading plan and to have stops in part of the plan. Because anything can happen when we trade. As much as you can have these big run-ups, you can definitely have shocking events, just like I just expressed with these three. But again, none of this is meant for any one particular person or anything like that. It's educational only. Here is the disclaimer right here that you can read. It's past performance is not necessarily indicative of future performance. And there was hypothetical trades. I wasn't in these trades. They're done explicitly for educational purposes only. There were no recommendations whatsoever. Thank you very much. And if there's any way I can help you, email me. I'm here to help you. Thank you.